The following is a presentation of TFNN.
All right, welcome everybody to today's Option Hour, the Tuesday, 1 p.m. Eastern Standard Time, June 14th. Let's get things rolling, and as you guys know, my name is Don Kaufman, and I will be taking you through the Options Hour today. All right, so, wow, they got the music just rocking over there today. It's good stuff. Anyway, with that, so the Options Hour, as you guys know, this is a call-in show. You guys can call us with your questions. They can be stocks, options, futures related, even currencies. Go for it. Fire away. You know, last week we had some great convoluted option question calls. It was good stuff. This week, hey, sky's the limit, so feel free to give us a call. Of course, 877-927-6648 is the call-in number. I'll give you guys a quick rundown of what I am seeing in the marketplace, and then, of course, we'll jump to a couple of callers as we go ahead today. You know, pretty much every time I do this particular show here, and I've been doing it now for about 5-6 months, maybe my 6th month into the show here. Every time I do one of these shows, I have some kind of underlying theme, and, you know, I was thinking to myself a couple of minutes ago, I got nothing today. I got nothing for a theme. But today's theme of the show is what I'm going to call good trade, bad trade. Really, what I want you guys to do is feel free to call in. And, of course, you can ask any of your regular option questions or irregular option questions. But also, if you've had a really horrible trade at some point in your trading career and you'd like to talk about it, we really want to hear about it. So we'll exploit you for our amusement today. I love talking about that stuff, and I'll probably kick it off because, you know, those are the most memorable trades in my career. Forget about every time, you know, you make money, you lose money. There are some trades that you absolutely butchered. Okay, you know, you had some type of a spread, you tried to fix it, you know, you took a great iron condor and you just absolutely squashed it into some pterodactyl of a trade out there. We definitely want to hear about it. Why? Again, because it's amusing to us. With that, I'll give you a quick rundown of the market, and we're going to jump to a couple of callers here. Futures up 17.5. NASDAQ futures up 26.50. Dow futures up about 140 right now. VIX down, $1.70 on the day. Also, bonds are actually off pretty good today, which is an indication, of course, of a rally. So you can see TLT down $1.15, TBT up 78 cents. Oil's actually up $1.54 today, and I kid you not, I'm looking at the headlines right now. Right before starting this show, I was tied up all morning long in some conference calls and so forth. I've been watching the market, but I haven't really been looking at news per se to what actually drives this marketplace. And I'm kind of laughing hysterically because I pulled up Yahoo Finance. I was like, what the hell, just pull up Yahoo Finance. So I pull it up here, and the headlines, kid you not, stocks soar on stronger signs of global recovery. That's headline number 1 under Yahoo Finance. Headline number 2 over there was economic report. Retail sales fall for the first time in 11 months. So then I read deeper into this. The retail sales were worse than expected, but, well, I shouldn't say that. The retail sales were better than expected, but actually dropped. So if you can understand that, the bottom line is what we're seeing is we're seeing a bounce. There's no question here, and everybody watching and listening right now is probably in agreement with that, is we were oversold. We're bouncing right now. Media is stretching here on stocks soar on stronger signs of global recovery. Pretty interesting. So with that, let's jump to a couple of callers, and feel free to call us today, not only about your option trades, but call us and tell us about the worst trade you've ever really had, because it's exciting to listen. Anyway, let's jump to our first caller. We got Tom in Tampa. Has got a question about put options. You there, Tom?
Hey, Don. How you doing today, bud?
Good. How's it going?
Good. Hey, I got a question for you. I write a lot of weekly covered calls. I used to do them monthly, but I love to do weekly, write them weekly. But and I'm writing the puts a couple of option expiration dates out. But, I mean, yeah, it's great when the stock's going down. I mean, man, you're looking like a guy. But, by God, when these things go to the upside, I mean, these puts can really, you know, decrease in value quick. And I'm just kind of wondering, I mean, it can really chew away at your profit quickly. And, you know, that's what I'm kind of dealing with this now, and I just want to kind of get your take. Where's a good place to dump the puts, I guess is what I'm getting at.
All right. So you've got one or two. I got a quick question for you. So you were actually buying put options on the sell-off, and this rally is just beating you up?
Yeah, exactly.
Okay.
I mean, it's been choppy here lately, as you well know, and you know, I write the covered call. Of course, you get the premium up front and everything. I like writing the puts. You know, a couple of options. In other words, you know, we're in June. I usually write them into July. A couple option expiration dates out at the same strike price. And like I said, you know, we're going down. It's fine. But, I mean, when these things swing up to the upside, you know, they can really hit you quick. And I'm just kind of getting a feel for, you know, where's a good place to dump some of these puts at sometimes. I mean, if I don't get called away one week, you know, I'm rewriting it again to get more premium. You know, I keep doing that, and that works well too. But
well, wait a second. I want to kind of clarify something. When we're selling off, you're short a put. Selling off is actually hurting you. The rally's helping you.
Exactly. That's what I'm getting at. Yeah. And you see those puts go down in value quickly.
Yeah, which is fantastic. And when do you actually buy them back? When do you exit these things? Well, you know what? On a day like today, first of all, if you're short a put on a day like today, the volatility is down on that particular put because the VIX is now down almost 2 points in the day. So this is a good time to buy back premium that you're already short. The other thing is we're rallying, so those puts are obviously going to be worth a little bit less. Ultimately, a day like today would be, you know, ideal for being exit some of those short put positions. Now, you know, on the covered calls, this is what you look for. You know, the covered calls have worked out.
Yeah, it's a good problem to have. I mean, I've just thought about not even buying the puts. I mean, because you're only in there a week. You know, most of these trades are in there a week. I'm just like, you know, why am I really buying these puts? I mean, sure, it's a very, very conservative strategy to use, but I'm thinking, you know, that's the beauty of these covered calls. You're only in there 4 or 5 days, and you're out. And I just thought, well, maybe I should just use a percent stop. When I get to that level, just get out of the trade period. I mean,
ultimately, listen, if you're just trying to shoot for premium generation, meaning you're just trying to sell some premium and you're trying to come out clean, I would just use spreads. I wouldn't even use the underlying stock. I mean, basically what you're doing is a version of a vertical spread. You might as well just utilize a vertical spread or some type of a kind of like a bastardized like calendar spread that is buying in the money option and sell, you know, the effectively like the covered call. So for the most part, you could, like if I was in the spiders, you could buy a deep in the money July option in the spiders and then sell the weekly options every week against that deep in the money call, because that would it would tie up a lot less capital than you going out and having to buy. For instance, a spider is $130 underlying. It's just, you know, that's creating synthetic stock. You'd be probably better off with that. Or if you just want to bang out like premium, meaning like you're like, ooh, I found a stock that's got pretty good premium on it, just sell vertical spreads, you know, or just utilize calendar spreads. It's all pretty much the same animal. Is for the most part you're trying to sell premium and get out alive. The thing is, with the vertical spread, the calendar spread, at least that's going to limit your losses. Anytime, you know, you start involving stock, you're buying a put, you're selling a call, you're collaring things and so forth, you got a lot of capital up in the air there. And probably not the best utilization of your capital in this marketplace. Are you trading spiders, or what are you trading? Just all over the place?
I'm sorry, what was that?
Are you trading the spiders, or are you trading which products are you trading? Because you mentioned weeklies, so there's not weeklies on a million products out there, but you know there's about 50 different products with weekly options. What kind
of
bank
products? Stocks, you know, I was trading some of those, you know, J.P. Morgan, Citibank, some of those.
Oh, good deal. All right, so you like some volatility. No, that's fine. That's fine. But
they're volatile. Oh, yeah.
Yeah,
you
got
a volatility. 3 days ago, they look like their toes bone. They come swinging right back on you. You know, yeah, they got the volatility, but.
Yeah, for sure.
But that's what I love about these weeklies. I mean, you're in and out in a week. I'm just like, well, why am I really buying these puts? You know, because I mean, they could just they just when they take off to the upside, they really chew your profit up, and that's what I love about these weekly options. You're usually out in a week.
Oh, absolutely, absolutely. So again, if you're just looking to bang out premium in that week on that particular stock, you know, I wouldn't even bother with a covered call. I would just use some type of, you know, autonomous option strategy in it. And anytime I ever talk about a covered call, I always say this: covered call. You know, our feeling is it's really designed for more of an investment-grade strategy. Like if you want to own J.P. Morgan Chase for the next 3 years, great, covered calls are fantastic. If you want to try to bang out premium next week, just use a vertical spread. Don't tie up the capital. You know, get in, get out, make it a clean trade. And when I say vertical spread, what you could actually do in there is create some type of like an in-the-money spread. You can actually buy a vertical spread with very little time value associated with it. So like J.P. Morgan's like $42 stock right now. There's dollar strike increments. For instance, you could buy like the 41 calls that are in the money and sell like the 44 calls and do it for like the month of July. It'll just have a lot less premium risk than what you're doing right now. And of course, you could do that in the weeklies as well. You know, anything goes out there. So take a look into that, though, because I think you'd be better off utilizing spreads, because sooner or later, you know, you may have an experience where you try to go out and buy the stock and sell a call, and you don't own a put, and that'll be the time that, you know, news comes out on that stock. Oh, we said the stock gets cut in half. All of a sudden, you're $20,000 in the hole.
Right. Yeah, exactly. That'd be exactly how it would work, too. Yep.
Yeah, and that'll never happen if you're just in the option strategy. You do a couple of contracts here or there. The worst you're going to be is whatever the risk is in the trade. You go out and buy a $3 wide spread for $1.50. You know, most you're going to lose in that trade is $1.50. You know, 10 contracts, you're in that trade for $1,500 of risk. It might be better off for you.
Okay.
Yeah.
Great.
Keep that in mind, though. All right, I appreciate the call, Tom.
Okay, thanks, Don.
All right, thank you. All right, so with that, I like this. We're going to play this good trade, bad trade. We got one caller on the line here, another one holding, so we'll go to that caller in just a moment. But remember, give us a call. This is a call-in show, 877-927-6648. And I was saying I love playing the bad trade. So if you'd like to call in, talk to us about an absolutely horrific trade. And, you know, Ken from Philly over here chatted in, worst trade, naked puts in the 2000 bear market. Yeah, I could see if you were naked short puts like, you know, one of the big tech stocks there as we came down, yeesh, that had to hurt. All right. Wow, that's good stuff. So being chatted over here, our show is also live on Tiger TV today, so feel free to tune in there as well. Naked short puts in the 2000 bear market. Man, Ken from Philly, if you do have the time, give us a call. With that, I'm actually going to jump over to our next caller. It's John from Philly. Got a quick question. You there, John?
Hey, Don, how are you?
Good. How's it going?
Say, Don, I'm in the den, so I can see your screen, by the way. But, Don, my question is for you is on options on ticker symbol SIL, Sam Isaac Larry.
All right, I got it up.
Okay, very good. Let me tell you, because you can see this pattern, the stock has come down, made a low in May, retested it yesterday. Don, I bought this stock outright this morning's open, just as a partial position.
Yeah.
Now, so that's where my head is at. Now, my question for you is, could you look at the options that trade on this security? Yeah. What I'm interested in, Don, if you were in my frame of mind, do you see any opportunity to be selling out-of-the-money puts on this with the idea that if the stock did decline and you had stock put to you, you'd gladly take it at a lower price? That's kind of what I would like to do. And I wanted to get your eyes as a real pro on options on selecting the right options to use for that tactic.
Sure. You know what? The first thing I always ask people whenever they talk about selling naked puts or buying stock is you want to own the stock. I mean, obviously you want to own this particular stock. And that's never a call I like to make for people. Like, you know, sometimes I'll say get long the market, get short the market. But when it comes to buying stocks in here, yeah, if you want to get long this stock, obviously you've picked a pretty definitive level here. And yeah, you know, looking at the chart, we're definitely forming a double bottom over there. But until maybe it breaks down to $20, but we'll have to see. The one thing I would look at here is first of all, the implied volatility on this underlying is decent. So it's a silver miner. It's 55% implied volatility. So to answer your initial question, is it worthwhile selling premium in here? The answer is absolutely.
Excellent. Good.
Yeah, so 55 vol is definitely, it's got some juice out there. The downside, there's not a lot of volume, not a lot of open interest here. That being said, if you just want to get off like 5 or 10 contracts, you're going to have no problem in here whatsoever.
Okay.
So that's nothing to be concerned about. The next thing I'll do is, you know, I've looked at volume and open interest. Then I'll drop down to like options, theoreticals, and Greeks, and I'll pull up like delta.
Okay.
And I'll look for an option to sell between like a 30 and 40 delta. You know, pretty much that cores me into like this the July. There's 31 days left in July.
Yep.
Got like the 22 strike puts, which are a 32 delta. It's right in kind of the wheelhouse of what I'm looking for.
Can you tell me why you select that delta range, please?
Absolutely. I'm going to get to there in just a second. So in here, that's exactly where I'm kind of driving right now. So we're selling a slightly out-of-the-money put. It's the 22 handle, which is the 22 strike put. which for the most part, I would be able to sell this option. Let's say I would be able to get it off at 70 cents. The market's 65.80, which is a wide market because it's not a very liquid underlying here. So if you get this thing off and collect 70 cents, if the stock tanked below 22, your effective purchase price then is $21.30.
Right.
Now, ultimately, why the delta selection? Delta is relative to probability of expiring. And on the platform, I can actually pull up probability of expiring. So what the delta really means is this option, there's about a 70% chance, in that neighborhood of about a 70% chance that this option expires worthless. And that's based on, of course, the delta, the probability of expiring. It's closer to about a 65% probability this option expires worthless. Right. So what you're doing is collecting X amount of premium with a decent probability, associated with it. And that's ultimately what we're kind of looking for in this particular trade.
Gotcha. Terrific.
So, it's really straightforward. So for the most part, when you go out and sell premium like this, I'll be honest, I tend to look for big down days when I sell premium. Like when we're up 60 cents on a day, it's not as advantageous to sell a put because, number one, markets are up and volatility is down. It's not always the greatest day to sell puts, but that's my contrarian kind of perspective. If you don't sell the puts today, you're going to probably, if we continue to rally from here, you might feel like you missed the trade, but don't feel that way. There's always a better day. There's always another day in the marketplace. That's the greatest thing about the market is it'll be open again tomorrow, and we'll have another day to be able to fire this position off. So, got any follow-up on that one?
No, that's it. That answers the question. Pretty damn clear. Thanks.
Yeah. All right. I appreciate the call.
Thanks, Don.
All right. So with that, there's a couple people chatting back and forth here in the Tiger Den. By the way, again, Ken from Philly, you should definitely give us a call, or anybody in the chat room there, or just listen to the show in general. If you've got a trade and you want to talk about it, whether it's a stock, an option, or a future, ultimately you guys can also give us a call, and we'll pull up your stocks and see if we can find a bullish or bearish or neutral trade in there. Hey, if you just want to talk yourself through a trade with me on the phone, that always makes it interesting for other people too. It's always surprising, how much you'll probably pick up that you would not normally have looked at when just walking through a trade with somebody else. That being said, today is also call in and tell us your most horrific trade day. So it's I always call this good trade, bad trade, but I don't really want to hear your good trades. I mean, listen, everybody gets lucky once in a while. Those are not the trades I remember. I remember, the trades where basically you were an absolute butcher out there, and I'll probably kick that one off here in just a minute. But anyway, Ken from Philly there was laughing out loud here. Don't want to relive the moment out loud. Basically, he doesn't want to relive the moment of selling naked puts in 2000. The irony, Ken, is one of my worst trades ever, and then I'll grab another caller here, dealt with a firm, and this was in 2000, and the irony is it was also surrounding some tech companies. In 2000, what I was doing was basically I was kind of managing risk for a firm, and we were also starting ThinkorSwim, so I was kind of contracting with ThinkorSwim, but primarily I was managing risk of a portfolio. And we had gone out and we had bought a tremendous amount of a handful of tech companies in a type of an arbitrage position. The position itself isn't all that important, but what's important to understand is the position was primarily hedged, meaning I had all the risk in this position hedged off for the most part. So the most part, I was buying stocks, and if the stocks declined less than about 30%, I was going to be profitable on this particular trade. Well, there is one company that I will never, ever forget. The company is called Citrix Systems, and I'll never forgive them for this particular trade, but we had bought Citrix Systems literally one day at $42, and I had a bunch of guys in a pit, and we had hedged the position very well, so we had mitigated most of the risk in the position, but again, we mitigated the risk within a 30% up or down window. So Citrix Systems one day closed at $42, and the next morning, I was actually out in Arizona at the time. The next morning, I get a call at 5:40 in the morning, and it was basically our guys, and they said, "Wake up, we're screwed." And I go, "What do you mean we're screwed? Which position is it?" And they go, Citrix Systems. I said, "We literally just bought that yesterday. How could we be in trouble on a trade that we just we bought it yesterday? We hedged off the position. We're fine, man. We bought the stock at $42. What are you telling me? Stock's at $20?" He goes, "No, it's at 21." And it literally went from $42. The next tick was 21 because their earnings were forecast was completely like nixed. It was probably one of the more brutal experiences because we were long, thousands and thousands of shares. This was a market-making firm. It was good stuff. I like to relive these Citrix systems, and I see their commercials on TV every single time I see them. I want to just barf a little bit. It's good stuff. Anyway, with that, I'm going to go to the next caller. We got Jason in Minneapolis. Got a question about the spiders. You there, Jason?
Yes. Hi, Don. How are you?
Good. How's it going?
Okay. Just three things. One thing is just rec. I'm a TOS client, and I do a lot of, like you do, a lot of trades on the spiders. And when I go to Analyze tab and I go to risk profile, I just see a bunch of spies. And so what I do then is go to my monitor tab and I take individual trades and I turn them up. I put them into the account, back into the Analyze tab, and I turn them upside down so I can see how each particular trade is evolving. Do you know what I'm saying?
Sure.
Like when I put something on a calendar. So I guess one suggestion I have would be under like when I have show hide positions and I'm showing simulations. It'd be nice if there was like simulations 1, simulations 2, because sometimes some of my simulations are merely just the existing positions I have on and the spies that I initially put on as calendars or verticals. And so that's like one set of trades, and then another set of trades would be like new simulations, which would be new trades that I want to add to my existing portfolio. That's just a thought. Otherwise, I get really confused, especially if
we have been looking at that, man, for years of a better way to do it. So what we came up with is also, the little check marks in the Analyze tab. You check them on, check them off, check positions on, check them off. Right. So for the most part, you can put simulated trades with real trades and so forth. But the thing that you bring up is an interesting one. So you have a 3-month calendar spread, and sooner or later you roll from May to June, June to July, and you're long, like, for instance, the August. And you're trying to actually calculate what it would be worth the entire position with all the rolls in there.
We have realized gains and losses.
Yes. We have never been able to come up with a decent way. Now, that's not a bad idea, what you just said, simulated trades 1, simulated trades 2, because what you're doing is exactly what I would tell you to do, is to actually add the rolls back in by, inverting them. And, man, that's something that, seriously, we've been thinking about for years. I work with Tom Preston, who kind of runs, like, product development for years at ThinkorSwim. And we have sat down and hammered that one out, and it's just it is not the easiest thing to overcome. But what you're doing right now is exactly what we would walk you through, and that is recreating the positions within the simulated trades over there. Okay. I wish I could tell you that there was an easy way to do it. Problem we've had with it, and we've built it in the past, is that then clients were getting confused. Why is it holding over positions that I've already closed? And that could just be, toggle on, toggle off. But you know what? We will definitely revisit that as we're reconstructing a lot of the Analyze tab for some new slick tools. I mean, I got to tell you, we haven't done anything to the Analyze tab in like 3 or 4 years. Okay. We built it, and then we're like, where are we going to go from here? That is one feature that I'd love to see in there for sure.
Right. And so that's like, yeah. So the deal is, like, for instance, like, with the new monitor layout, because for me, I'm fairly new at this, and I do a lot of spies, so I have calendars, this, that, and the other. But I want to see how each particular trade is evolving, and then, like, as far as my risk management, I want to be able to take something off, put something on. So then I'll like I said, I'll take that particular calendar, analyze duplicate trade, or analyze closing trade from monitor tab. Because monitor tab, there isn't like a thing that says analyze duplicate trade. I have to go analyze closing trade, and then I have to like do the ones that I sold and put them into the one that I bought, and then put in the price of the actual trade. What my price was that I traded at initially. Anyway, you know what I'm talking about. It's just,
I know exactly what you're talking about. Okay. Again, this has been like year-long debate. In a conference room with us. I'll tell you what, you can also, what a lot of our guys have done is simulated some of these trades back in on-demand. So there's a larger number of people that are starting to utilize on-demand to build simulated portfolios and keeping some of the roll values and so forth there. But I find that a little bit of a daunting task to some degree.
Okay, so here's my actual question. It's been a tough month, but I'm actually getting some redemption today because I put on a lot of spy put calendars, and I have the thing is I didn't close in yesterday because I was hoping I'd get a little bounce. I'm finally getting that bounce. So I have 131s like June Augies, 131s. I have June, July 132s. But so the ones that I have 3 days left, I mean, it's like I'm almost sitting like smack in the middle of the tent on these calendars, and I'm inclined to like maybe get a little more juice out of them by maybe closing them tomorrow. I realize at some point I'm going to either have to roll or close them out, but I don't realize I'm tempting fate because but they seem pretty healthy right now.
You are, man. You're close. So you know what? Anytime I'm in that position like you're in right now, first of all, I like to close my inventory.
4 to 10 days.
Today is pretty much like I close, and I have been closing inventory all morning long. I like to close it like the Tuesday of expiration week. Sometimes I screw up and I'll close it on Wednesday. But if I'm in a position like you're in right now, I would actually, when I'm right there and I'm so close and I just want to try to burn like another day's premium, I'll close a good chunk of it today and I'll let some of it ride. So I'll close like if you had 3 different strikes covered, I'd close maybe 1 or 2 of them out and let the other ones actually roll. Because every time that I'm in your position and I haven't done anything, all right, that indecision always led to it being the wrong decision.
Wrong.
Okay. Yeah. I mean, basically, I can tell you in my own trading, like anytime I've been indecisive, that's cost me always. Indecision has always cost me more money than even if I had made the wrong decision. I mean, they just basically, their indecision and like the deer in the headlights, they're like, I just want to grind out another day. That's usually a bad thing. That's for the years.
All right. Probably have other callers waiting, so I'll let you roll. But if you did, I have one more question. But that's cool. That's cool. Ex-dividend for SPYs is coming up on
Thursday night.
Thursday night. It's interesting because the 131 June puts the extrinsic, like for the puts, is so much higher than the extrinsic for the calls at the same strike. I didn't know if that had anything to do with that.
Absolutely does. So the dividend, with the dividend, nobody knows exactly what the dividend is going to be as of yet, but the dividend is priced into, of course, those puts right now because they're estimating the underlying to drop down by, let's say, 53 cents or something like that. So that is calculated into the delta right now. Yeah, so it's not an anomaly at all. It's definitely the effect of the dividend out there. And if you're short Spider Premium, you got some in-the-money calls. You got to be careful on those things because you will get popped on that short dividend play.
Okay, that's good to know.
Yeah.
All right.
Yeah.
Thanks
all right, man.
for your help.
I appreciate the call. Thanks a lot, Jason. All right, so we're going to jump right to the next caller here. We got Kevin from Jersey. You there, Kevin?
Yes, I am. How you doing, Don?
Hey, sorry to keep you waiting so long, man.
It's okay. My question for you this week is I want to take advantage of volatility.
Okay.
We have earnings on Thursday of Research in Motion. The volatility right now is 126. And I'm still learning pretty much on the puts, the verticals, and all that. I'm doing well, actually, with the spider.
Okay.
I got out last Friday. I'm scared to jump back in yet on the spider. But anyway, Research in Motion, the earnings, if you were to sell a 35 and buy a 32.50 vertical put,
yep,
on Thursday before 4 o'clock to ride overnight, you have a good chance, if the stock stays where it is or moves up a little, of collecting the premium because of the disintegration of the volatility and the theta because you have expiration day. Is that
so?
How you play something like that?
Yeah, so volatility is completely jacked up in here. You know what? I love when companies like this, like Google does this all the time. They release the earnings literally on Thursday night of expiration week. I love that because you basically got like literally a one-day play in place here. And on this particular strategy, first of all, one of the key things is if you look on ThinkorSwim, and I don't know if you have it up right now, but the market maker move, there's an MMM on the upper right-hand corner of your screen. And the market maker move is implying right now, it's implying a $3.50 move in either direction. It's something to keep in mind.
That was my next question.
Okay. So that's
for the earnings. In other words, it can go up or down $3 and 50 cents.
Yep. Because basically what we're doing is we're taking the implied volatility, and we're extrapolating that out to a one-day move, meaning that this implied volatility, which is the risk in the options, is implying a $3.50 move either up or down right now. And this is where the market maker move on ThinkorSwim becomes so effective, because it now gives you clarity to what the world is pricing the move to be. So right now we're at $36, all right? And obviously you still got a couple days to go to the earnings. The one thing you better keep in mind is this implied volatility could very well grow the closer we come. So this $3.50 could actually increase depending upon the implied volatility. Now,
but my strategy was not to do anything until to 4 on Thursday.
I would probably, if you're going to trade this, trade it earlier in the day on Thursday morning. And the reason is by Thursday afternoon, sometimes implied volatility will peak on Thursday morning, and it'll start to fall off in the afternoon because some of the information is already starting to disseminate out. But with that, what you're doing, the 35-32 spread, is fine as long as you're kind of bullish in here. I mean, your risk is limited. You're taking good advantage of the implied volatility on there. I don't like to utilize calendar spreads and such because they're just going to get you into trouble. But no, hey, listen, if you're bullish, I think, selling that spread is ideal in here. You may be able to collect, looks like in the neighborhood of like 70, 80 cents right now.
Yeah, I see that.
Yeah, I mean, it's
downside for today is 34.23 if you were to do it today.
Right. Hopefully you get if you're going to sell the 35.32, hopefully you get a little bit of a downtick in the stock before you do it. So if like the stock ticks down to like 35.50, which is pretty close to the low of the day was 35 and change. It's it's actually very close to the lows of the day. But if the stock downticks a little bit during the day, you might be able to get this spread off. So keep that in mind. But the one thing you also want to keep in mind is when you do this trade, it's a total shot in the dark. When you wake up on Friday morning, you're going to find out.
I've played REM on every earnings for the last 4 years, and I've had some unbelievable 400%ers positive.
Oh yeah, no, this could be a great trade. It could also be a train wreck. And RIM is a stock that has just absolutely had the living crap beaten out of it. I mean, this stock
I bought it when it was $140. So I had it when it was that high and did well with it. But the other question is if I do put this trade on, and the MMM, the market maker move is 350, and it does drop to that amount, the volatility is going to get destroyed.
It is. It's not going to matter. It's not going to matter.
You might lose as much. You might not lose as much. Is that possible or no?
No, your 35 puts are going to go in the money. So volatility on the expiration date doesn't mean as much as whether the option's in the money or out of the money. So let's say we're at 36 right now, and let's say we just dropped $3. If that stock goes from 36 to 33, doesn't matter. The 35 puts that you're short will be in the money by $2, and you're basically going to lose on that spread. It's not a huge, it's not a huge loss out there, but it's you're taking a little bit of a hit. But yeah, this is going to be an interesting trade. I'll have to keep my eye on this one. I honestly haven't looked at it in a while.
As beat up as RIM has gotten, and this is the lowest I've ever seen it. So, with their new playbook out, and in 15 new countries, and Mexico, they said, doesn't know anything but the BlackBerry. And I'm hoping that it stays where it goes up a couple dollars, and hopefully I'll see what happens here.
I want to play devil's advocate. First of all, it's Mexico. Second of all, do you own an iPad, man? Those things are phenomenal. I got them all over my house. I keep telling people.
I want to buy a BlackBerry playbook, to be honest with you.
I keep telling people the iPad is my solution to problems with my in-laws. I bought 3 iPads, and every time somebody comes over the house, especially in-laws, I just hand them an iPad, and it shuts them up for like the entire day. I found it to be cheaper than Jack Daniels. Yeah,
that's a good idea.
Yep, it's good stuff.
Is there another way that you could put a little more insurance on this play on the downside, like by buying a put, or is that defeating the purpose of your profit?
I think it defeats the purpose of it. I think that what you're doing is ultimately is the way to go. Again, if you're a little bit bullish on it, just sell the put spread. Don't try to get it too cute because it's a tough one.
Okay.
Yeah.
All right.
Yeah.
All right, Don. I appreciate the info. I'm going to give it a shot and see what happens. So.
All right. Tell me about the RIM device after you get it, because I'd really love to know about it. The RIM tablet coming out.
All right.
I haven't seen it. All right, man. Thanks a lot.
Thank you. All right.
So with that, we're going to jump right to the next caller here. We've got quite a list of callers here. Mike in San Diego's got a question about leaps. You there, Mike?
Yes, Don. Thanks for taking my call.
Yeah, sure. Hold there.
I was listening yesterday to Tom Salznoff talk about some strategies, and he talked about a stock replacement strategy using a leap. And I wanted, since I didn't have an opportunity to talk to him about it, I thought I'd chat with you about it.
Where are you listening to Tom at? Are you listening to Tom on Tasty Trade?
Yes.
Oh, man, that's actually growing in popularity right now.
Yeah. So he mentioned a strategy that was kind of interesting, and that is using a leap going out to maybe January of 2012 and buying a call that's slightly in the money, in the money, and then selling a call in next month in July, slightly out of the money.
Absolutely.
And it seemed like it would pay for itself in maybe three cycles.
Absolutely. So all that's like an age-old strategy of stock replacement. What he's doing is he's substituting the stock with a in-the-money leap. Now, the danger of that could be that the stock soars to the upside. If the stock does soar to the upside, the leap goes deeper in the money, but so does the call that you're short. So you just have to get used to the idea of rolling the short calls from month to month. If you understand the roll is the key aspect of it, then you're fine. And typically, the option that you're going to sell, so the option you're buying is the leap. It's in the money. The option that you're selling on a month-to-month basis, you might sell an option that's, a strike or two out of the money, or a 30 to 40 delta. They basically mean the exact same thing. So sell a 30 to 40 delta option, sell a strike that's a month out of the money, and roll the trade a couple of days prior to expiration, which means buy back the short option and sell the option of the next month against that same leap. That's the whole logic of it.
Okay, now that's a slightly neutral to bullish kind of a trade?
It is. Actually, theoretically, it's a bullish to neutral trade, meaning that it's bullish first because you do own an in-the-money leap, which basically is synthetically long stock. It's creating synthetic long stock. Anytime you're in a covered call position, it is a long strategy. You're bullish. And but it also profits from neutrality in the marketplace. Even if you go down a little bit, it's still good. So it's from a probability perspective, it's a good trade. It's definitely a decent thing to do, and it's relatively straightforward. But the underlying theme is anytime that you were to go out and buy a leap or you were to go out and buy stock is that you still want to own the stock. So make sure, even though you're buying that leap out there, you think you're in just a pure option strategy, you've created a synthetic stock position, and make sure that you want to be long that stock. If you don't want to be long the stock, you instead of using that strategy, you could just utilize a calendar spread, which is, sell an option, for instance, in July and buy an option in September, which is also kind of a more simplistic option version of that synthetic covered call.
Okay, so let's just say I'll use the example HP, and if I go out and I do that strategy, I would buy the January 12, 30, let's say 30, 34. And,
okay, that's a little bit close because that's the 34s are pretty much right at the money. So the stock's at 34 or 74. You're going to have to go a little bit deeper in the money. Like the most shallow I'd go is like the 32s or even the 31s, a little bit deeper in the money because you want to make sure that you've got some delta protection, meaning that the delta is truly creating something similar to the stock.
How much delta? You're looking at a delta protection in terms of difference between the deltas?
Right. I try to get when basically the January 2012, what again you're really trying to create is a synthetic stock. So try to make the delta over, let's say, a 70 delta.
Okay, that's good to know.
So I'm a little bit in the money over here, right?
Okay, so if the short strike, let's just say, is exercised, then what's the procedure of how would I take care of something like that?
All right. One of the first things is so you're going to sell first. You're going to buy the January. Let's even go to the 30s. I'll just make the math easy. So let's go to the January 30, 2012. They're 75 Delta. They're basically trading for $6 right now. Then you turn around and you sell a July, for instance. Let's say a July like 35 call against it. Not a huge amount of premium in this stock, but that's fine. And you collect, some 70-odd cents out there. But you've got, another 6 months of premium to be able to sell. Ultimately, this leap is still in the money also. If you think about it, the 30 calls are in the money right now by almost $5. So there's an intrinsic value associated with this leap, meaning that although you're paying $6 for the leap itself has $5 of true value, so you're really only paying about $1 of extrinsic value. It'll take you about 2 months of premium selling to generate an area of profitability in here. Now, how can you lose money? Well, you can lose money if the stock absolutely craters, all right, and crashes. You can lose your $6 on the leap. It's not likely to lose the full $6 because even if the stock dropped, for instance, from $35 all the way down to $30, these leaps are still going to be worth $1 or $2. So it's a nice protected position from that perspective out there, and I hope that kind of makes sense. And basically, you're going to want to buy back. Hang on just one second. You're going to want to buy back the 35 calls before we hit expiration. But let's assume that you're assigned. Okay, even if you're assigned, don't worry about it. So you're going to be short the stock. So you just buy back the stock and then sell the call in the next month. It's not the end of the world to be assigned.
Okay, so then if I do that, if I am assigned by just happenstance, then I would keep the long leap in my portfolio?
Correct.
Okay.
Remember,
so that long leap is just basically there to keep the margin. It helps keep the margin down.
Absolutely.
Margin requirements down.
One thing to remember, if you're assigned short stock. But basically, you're long stock because you're long the January 30s, right? So basically, you're long stock and you're short stock, so it's kind of a lock. So getting assigned is not the worst thing in the world. It really freaks people out because the margin involved. All you do is basically close the short stock position by buying in the stock and then just sell the call in the next month, and you're ready to roll again.
Okay. All right.
Yeah, and that's really it. I mean, it's a very straightforward strategy. Nothing more complicated than a covered call.
Would I exercise the long call to buy the stock, or just leave the long call alone and just buy the long stock?
I would actually leave the long call completely alone and just buy back the stock. Because anytime you're exercising it, then it would just basically blow you out of the position, and you'll lose all the time value that you have left in those January 2012. So when you go out and you physically exercise an option, all right, you got to make sure that it doesn't have any time value in it, because if you exercise the option, it basically gives the time value away.
Yeah, that's right. That's a good point. Good point.
Yep, so keep that in mind.
Okay, well, thanks, Don.
All right, I appreciate the call. Thank you.
Right, bye.
All right, so, we haven't had a lot of people with good trade, bad trade here today. Just bad trade, it's good stuff. Anyway, let's jump to another caller here. Markets literally haven't moved since we started here. Futures up again 17.5. NASDAQ futures up 28.5. Dow futures up 146. Bonds again are off big today, which is actually helping me because I am monstrously long TBT, which is up 84 cents today, which is the first uptick we've seen in TBT in a very long time. So, look at that chart. That is just brutal. I wouldn't even want to ski down that slope. Imagine being long this stock, and then imagine you're in my position. So we're talking about good trades and bad trades here. This TBT has actually been a phenomenal trade for me. The last couple of months has been pretty brutal because I am definitely long in various ways TBT right now. Being long TBT ultimately means you believe that interest rates sooner or later are going to go up. I believe, and I will continue to believe. Bernanke hates me. Anyway, let's jump to our next caller here. We got Richard in California. He's got a question about Netflix. Are you there, Richard?
Yeah, I'm here, Don.
Hey,
so the question is, thank you. I'm just getting to understand the logic of these things. So I'm pretty new to the whole option trading world. And the question I have is, I sold the June 275 Netflix calls and bought the June 280 calls. And what I want to do now is close that out, but I don't want to pay 2 transaction fees if I can avoid it. And what I'd rather do is kind of establish the same position in July. And so it's kind of, I want to, in a way, roll that vertical spread into July. Is that possible to do? What's the name of that?
Are you on ThinkorSwim?
Yeah.
Okay, then you can do it.
Okay.
It's called the vertical roll. It's actually what it's called.
Okay.
Spread. So you're in a 275, 280 short spread, and you basically want to be short that spread. Here's the one thing is you still have to pay the individual leg fees, meaning if you have like $1 per contract, you still got to pay the $1 per contract. There's nothing I can do about that, but it'll save the ticket fee. So what you want to do is come down to, and it'll look like sell, and it'll say vertical roll. Okay, and what that'll ultimately do, it says sell vertical roll. You can set up buying back the spread for 1 month and selling the spread for the next month. And I actually just went through it. I don't know if you're watching the screen show right now, but for the most part, go to the 275s in June. Okay, so the 275s that you're short in June, right-click on them, drag down to sell, all the way down to vertical roll. Left-click on vertical roll, and what that'll do is it'll populate buying back the June 275, 280 spread and selling the June 275, 280 spread. It's done right now. It looks like for $1.16 credit. So the entire trade is $1.16 credit if you roll it forward.
Okay, awesome. One other quick question is, why is it that ThinkorSwim or all the other displays I've looked at with options, if I buy a vertical spread, why can't the display show me that always as the spread as opposed to the individual legs that I then have to continually remember are together?
Oh, man, you can do that. Just change it over in the monitor tab. Go, like if you're in the new layout over there, under the position statement, it says watch spreads. Under position statement, when it clicks watch spreads, just click on verticals, and it'll just break your verticals apart. So to be honest with you, I like to see it the way that you don't. Like I like to see just a bunch of crap and inventory all thrown together. I love it. It just reminds me of managing risk. But a lot of clients, they like to see vertical spreads paired with vertical spreads and calendar spreads matched with calendar spreads. But I'll teach you one other really cool way to do this. And there's another cool way to do it, and just go by trade time or by order type, meaning it says arrange positions, and you can arrange positions by order type, and it'll remember what's a vertical spread, what's stock. So I would say you are better off arranging positions by order type is the easiest.
Gotcha.
So,
okay, great.
Yeah, play around with that, and you can do all of that. Over the years, I've spent a lot of time kind of manipulating how the monitor tab and so forth looks, and yeah, people love to track irons with iron condors and calendar spreads with calendar spreads, but that's what we're built for.
Cool. Thanks a lot, Don.
Yeah, thanks for calling us to call today. So with that, I know we're kind of already approaching towards the end of the show here, and I'll kind of wrap up for a couple of minutes, but we might have time for one more caller. It's 877-927-6648. I'm going to have to do this again next week and give you guys a little bit more primer, but we want to hear about your really crappy trades because, well, we didn't have much to talk about today, but we want to exploit somebody over here. The only one that came forward was Ken from Philly, so thank you, Ken, for telling us about your really crappy trade back in 2000. And I told you guys about one on Citrix Systems that I will never forget. Stock one day was at $42. The next day opened at 21 and blew apart a position. The best part of that trade, which I didn't tell you, the only the saving grace over there, it wasn't my money, which is even better. So if you're going to trade somebody else's money, not a fun business. By the way, trading your own capital is the way to go. Trading other people's money, that's a stomach-wrenching job out there. Anyway, with that, kind of a quick wrap up here on the day, and I'm going to give you guys, my take on today's rally. This is just simply a little bit of a relief rally. The VIX was really starting to climb here in the last couple of days. So the VIX neared basically the 20 handle, and the selling pressure in the last couple of days it wasn't that strong. But last week we saw some real selling coming into play. Where do we go from here? I mean, to be honest, this is such a news-driven, politically driven market right now that it's hard to say. I mean, I have to tell you, in the short term, I'm definitely still a little bit bearish. In the longer term, though, I got to be slightly bullish. When I say longer term, when I'm, months and months out, I got to be a little bit bullish in this market because ultimately there's just not a lot of places to put capital today. I mean, bonds right now, come on, they're not paying anything. CDs, oh, yeah, that's really good. I can make 1% if I just leave it there for the rest of my life. There's just not a lot of places to put capital. So ultimately, you may get appreciation of the marketplace on several different fronts. The other thing is everybody on the street right now is really talking about the dollar being just, clobbered. If the dollar gets clobbered, what does that do to the S&P 500? And this is a relationship that a lot of people don't look at, but let's think about this in terms of oil, and I'll kind of leave you guys with this thought. If you were to look at oil today, oil's at, basically oil's $100 a barrel. I know it's $98.71, but, let's say oil's $100 a barrel, but that oil is priced in U.S. dollars. So now contemplate that the U.S. dollar got cut in half tomorrow. So if the dollar was no longer worth what it is today, the U.S. dollar gets cut in half. The barrel of oil literally trades against the U.S. dollar. A barrel of oil almost doubles in price. So if you have the assumption that you believe that the U.S. dollar is going to get crushed down, that could actually have appreciation factors in things like the S&P 500, meaning you could actually see the S&P 500 appreciate simply because the dollar is collapsing in and around it. So these are things to kind of keep in mind with any of your strategies that you're kind of in play, but a lot of us are a little bit more shorter term than that, so it doesn't really matter. But again, short term still a little bit bearish right now. We'll see if this relief rally holds here. It's definitely going to hold here today. I have no question in my mind that the relief rally continues today. The bonds are confirming it. The VIX is confirming it. Will hold up today. But hey, tomorrow is a whole new day of crappy news that makes the market rally. That's basically what we had today. I love that. Stocks soar on stronger signs of global recovery. And the very next news report that I see, economic report, retail sales fall for the first time in 11 months. I mean, literally, you can't even, fathom stuff like that, but that's what our headlines were over here in Yahoo News. Anyway, with that, of course, I will be back next week. In fact, next week I think I'm going to be doing this live from our Chicago offices. I'm at Scottsdale, Arizona right now, but I'll be doing it live from Chicago, and I'll try to bring in a couple of good callers. Maybe I'll even drag some of the guys from our Chicago offices into our little mess over here. Anyway, on behalf of ThinkorSwim from TD Ameritrade, myself, that's Don Kaufman, thank you guys very much for joining us for the Options Hour today. All right, everybody, and bye-bye.